On Feb 14, 2026, Chamath Palihapitiya said something on the All In podcast that sent the entire finance world into a meltdown. Here are his exact words about Warren Buffett's legendary pre-2000 returns.
Warren Buffett's returns pre and post Reg FD. His returns were double the market returns. And the minute that he became illegal, he generated zero alpha.
And Chamath is mostly right. But he's also missing the bigger story. A story that is actually great news for you and me. Here is why this isn't just Twitter drama. Warren Buffett is the most cited investor in the world. His philosophy, buy great businesses at fair prices and hold forever, has been copy-pasted into millions of portfolios. Entire financial plans are built on the assumption that Buffett-style investing is the gold standard. But what if the environment that made that strategy work no longer exists? And what if the thing that replaced it actually favors you, the individual investor, more than it favors any hedge fund on the planet? So let me explain what actually happened. Before the year 2000, there was no rule stopping a company's CFO from calling Warren Buffett privately and saying, "Hey Warren, just so you know, our earnings next quarter are going to blow estimates out of the water." That wasn't insider trading in the traditional sense. It was access. And people like Buffett, who managed billions and had direct relationships with executives at America's biggest companies, had that access exclusively. Regular investors did not. Then, in October 2000, the SEC introduced Regulation Fair Disclosure, or Reg FD. The rule was simple. If you share material non-public information with one investor, you share it with everyone simultaneously. No more private phone calls, no more selective briefings. And what happened to Buffett's returns after Reg FD? Before 2000, he was roughly doubling the S&P 500's performance annually. After 2000, his returns essentially matched the index, sometimes less. Chamath showed this data live on the podcast. The numbers check out. Now, this doesn't make Buffett a fraud. The man built the greatest long-term investment track record in history. He's clearly brilliant, but you might be thinking, if his edge was access and access is now illegal, then his entire playbook is obsolete. That is exactly the right question, and the answer reveals something much more interesting than a scandal. There's a second Buffett problem almost nobody is talking about, and it's messing with how millions of investors think about valuations. The Buffett Indicator compares the total US stock market cap to GDP. Buffett himself once called it probably the best single measure of where valuations stand at any given point. Right now, it is at its all-time high of around 216%. During the dot-com bubble, it was around 100%. Sounds terrifying, right? But here's the structural flaw nobody talks about. The indicator was built for an era when American companies made their money only in America. Today, Apple generates over 60% of its revenue outside the US. Amazon operates in dozens of countries. Google, Meta, Microsoft, all of them are global businesses. Their market cap reflects global revenue. But the US GDP only measures the domestic output. So you're basically comparing a global numerator to a domestic denominator. The ratio will naturally inflate as companies globalize. That's not a bubble signal. That's just structural change being misread as overvaluation. On top of that, today's biggest companies are asset-light. Google doesn't build factories. Meta doesn't run warehouses. Asset-light businesses naturally command higher valuations per dollar of GDP than the steel companies and railroads that existed when this indicator was designed. Even Buffett has since dialed down his endorsement of this indicator. But the fear-based headlines keep using it as the only measure to gauge overvaluation. Here is what Chamath did not say, and it's the most important part of this whole conversation. Reg FD didn't just take away Buffett's edge. It gave every retail investor the same information at the same time as the biggest funds on Wall Street. When AMD announces a partnership with OpenAI, you see it at the exact same second as every hedge fund manager in New York. When Palantir reports earnings, the data hits your screen the same moment it hits theirs. The information asymmetry is gone. And that's the most bullish thing that has ever happened for individual investors, even if most haven't realized it yet. What matters now isn't access to information. It's your ability to process that information and act on it. Speed, conviction, and the ability to size your positions without needing a committee sign-off. Take Palantir for example. When I first bought it at around $7 in 2022, traditional value metrics, the ones Buffett would use, said it was expensive. High PE, high price to book. The old framework screamed stay away. But if you looked at the rate of improvement, the revenue growth accelerating, government contracts expanding, AI narrative building, the stock was extremely cheap relative to its future potential. It went from around $7 to around $200. Buffett style analysis would have kept you on the sidelines of such a stock this entire time. And right now, some of the biggest companies in the world are at genuinely compelling valuations. Meta's forward PE is around 22x, Google is around 27x, Amazon is around 26x. These are companies growing earnings at 20+%, but priced like boring industrials. You don't need Buffett's old phone calls to see that. Just ask ChatGPT or Gemini and you'll have a reliable analysis in seconds. This is my honest view. Warren Buffett is one of the greatest investors who ever lived. There's no denying that. But his playbook was built for a specific era. An era where information was power and power meant access. That era effectively ended in 2000. The era we're in right now rewards something different. Speed of analysis, independent thinking, the courage to act on your own conviction without needing consensus. These are things that a motivated individual investor is structurally better at than a committee-run institution. I'm not anti-Buffett. Some of his principles, like buying quality, understanding the business, thinking long-term, are timeless. I definitely consider companies like Meta, Google, and Amazon cheap or fairly valued right now. But the Buffett Indicator is no longer as relevant as it used to be. And the specific edge that made his pre-2000 numbers legendary, that edge is long gone. And the gap it left has been filled by conditions that genuinely favor retail investors who know how to use them. That's not pessimism about Buffett, it's optimism about us, the humble retail investors. The next video in this series is the one I know is going to get the most debated. Is AI in a bubble? I've taken real positions with real money. I'll show you both sides of the argument and then exactly how I'm playing it in 2026. Subscribe now so you don't miss it.